Hello, ladies and gentlemen. I hope you're fine wherever you are. I am the ACCA tutor, Mr. Jeremy Timukulu. You all know me so far. We have been uh, along quite a while. Okay, we have been together for quite a while now, and now you're getting used to the way I present these lectures, the way I talk, and so forth. All right, and I'm also starting to be comfortable with you guys because you're so wonderful people. You do not forget to subscribe whenever you watch a good video like this one. You also don't forget to share it. You also continue to like, and sometimes you also advise us where we are getting it wrong. So that's good. That's how we can call it a global community, okay, of learners and tuition providers and knowledge sharers. Okay, so in this particular video, ladies and gentlemen, I'm going to take you through three accounting standards. All right, three accounting standards as part of our ACCA FA lecture series, the ACCA. All right, the ACCA Financial Accounting Lecture Series. All right, so we're going to start with this particular accounting standards, all right, that deals with provisions, contingent liabilities, and contingent assets, which is IS 37. We are also going to touch a bit on property, plant, and equipment, where we'll be guided by International Accounting Standard number 16. We then have to rest our case dealing with irrecoverable debts and allowances, which is the remit of IFRS 9. Okay, IFRS 9, financial instruments. Remember, receivables are financial instruments, and we will be guided by what is called the expected losses model. Okay, the end is expected losses model. All right, so in short, this is what we are going to do in this particular lecture. Most people have been worried, like my recent students, they've been worried, like, hi, but how come we deal with receivables, but they do not have an accounting standard? And I said, hey, there is an accounting standard. It is you who doesn't know which accounting standard is actually responsible. All right, receivables, ladies and gentlemen, starting from today, receivables are part of financial assets. All right, financial assets. So they are treated as, under an accounting standard responsible for financial assets, which is IFRS 9 financial instruments. All right, so I'm sure there we are covered, and we need now to actually race into the business of the day. Remember, by the way, if you feel like, hey man, we are doing a great job, we are doing good things, we are helping the community. Our community has grown from a local community to a national one, and then global. Okay, it has now become a global community where we expect you guys to just get this knowledge and help the business environment to thrive. Okay, if we know accountancy, then the opportunities of business failure are going to be limited, because the type of information that is going to hem about the business environment, that is going to be found in the business or commercial environment, is going to be rich and quality information. So this is why we are thriving to ensure that everyone has got access to financial accounting information. By the way, we do not only offer this line of knowledge, we also venture into all the other ACCA subjects. Okay, remember, the ACCA qualification is actually a global standard qualification, which means that if you start and you are a holder of an ACCA qualification, then you are actually going to be somebody of repute. All right, so we are going to, we do teach other ACCA modules as well, and we also offer mentoring for the ACCA Oxford Brookes University Bachelor of Science in applied accounting degree. All right, so once you become our student, you are likely to enjoy a one-stop shop where you get everything you need with regards to the ACCA qualification. All right, so if you feel like we are doing this great job and you want to help or to support us doing the right thing, then please just scan your phone, all right, on that QR code, which will take you directly to the place where you can donate whatever you can manage. Okay, this is not a forced matter, but it should be out of free will, okay, out of your desire to help us. All right, but do not also forget to to subscribe to this video, to share it with your friends, to comment, so that we improve. Because if you do not give us feedback, we are not going to improve. We are going to call ourselves professionals or experts when in fact we still need to learn. All right, of course, learning is a continuous thing, but there is a situation where we might claim things which are unsubstantiated. In that situation, you are free to actually let us know, okay, in a peaceful way, in an interactive way, on those areas we should enhance our proficiency. All right, so without wasting much of your time, ladies and gentlemen, let us get straight to the business of the day. All right, provisions, contingent liabilities, and contingent assets. Like I said, these items are actually a remit of IAS 37, International Accounting Standard number 37. Now, the objective of this lecture is that we should, by the end of it, be able to define what a provision is. Let me just try to get a more darker pen, all right, because this one is not taking me anywhere. All right, define a provision, contingent liability, and contingent assets. That's our first objective. And then describe the requirements of International Accounting Standard number 37, provision, contingent liabilities, and contingent assets. What does this standard require us to do? All right, and remember, these requirements could be in terms of presentation or disclosure. Okay, now provisions, contingent liabilities, and contingent assets. Here we are worried about the definitions of important names, okay, or terms. All right, definition of important terms. All right, and we should actually be guided according. If we start by knowing what this is and what that is, then we can proceed smoothly. All right, we have seen that this standard is actually titled provisions, contingent liabilities, and contingent assets. But what are they? What are these animals? What are they? What are they? What is a provision? A provision is a liability of uncertain timing or amount. The word "or" is actually an empathetic, okay? It is actually a strong word, okay? Which means this amount, okay, or this this thing called a provision, or this liability, has got two components, okay, or two characteristics. It can be either in the form of timing itself. The timing of this liability is actually uncertain. That is, the time when it should be settled is not yet established, or even if the timing has been established, the amount of this liability is actually not known or not certain. Okay? So this is why we call it a provision, because there is uncertainty attached to it. Okay? There is uncertainty attached to it. So by the end of the day, we then have to create a provision. All right. It doesn't mean that they should both be uncertainty in terms of timing and then uncertainty in terms of amount. It doesn't work like that. It only works by having uncertainty in either timing or amount. All right. If then both the amount and the timing exists, then by the end of the day, it loses to become a provision. You will discover as we go ahead with the lecture. All right. What about a liability? A liability is a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources or embodying economic benefits. Which means when we are talking of a liability, there is actually an obligation that is attached. All right. There should be some proof that there is a present obligation. Okay. And we are also guided by the conceptual framework 2018, okay, which says that a liability is a present obligation of the entity to transfer economic resources as a result of past events. Which means an obligation is a duty of responsibility that the entity has no practical ability to avoid. If there are alternatives for us to avoid this obligation, then it ceases to be a liability. It ceases to be a liability. Okay, so when we are talking of an obligation, we are saying there are no alternatives available for us to avoid meeting this obligation or duty. Now, we have got animals called contingent liability and contingent asset. A contingent liability is a liability that may result but depends or is contingent upon the outcome of certain events. So it is conditional. For example, the company may have been taken to court, but the outcome of the case is not yet known. If they lose the case, then they may have to pay a fine. There is therefore a potential liability, but it is not certain. This liability is not certain. The question is as to whether or not we show the potential liability in the accounts. So by the end of the lecture, we should actually be in a position to determine if this is actually a provision or it is simply a contingent liability. We also know how to treat a provision and how to treat a contingent liability. Now, a contingent asset. This is, it is where there may be an asset resulting for the company, but again, certainty looms. Okay, uncertainty looms. All right. An asset is potentially there, but without certainty. All right. So in that situation, we are having a contingent asset, and like I said, by the end of this lecture, we'll also be able to know how to treat or to account for contingent assets. Remember, they are assets, but which are conditional, okay? Conditional on certain events. Now, 3 conditions which should exist for us to recognize a provision. International Accounting Standard number 37 states that a provision should be recognized, which simply means included in the books or in our accounts as a liability in the financial statements when all the 3 conditions are met as follows. An entity has a present obligation, legal or constructive, as a result of past events. So if it is an obligation that is going to arise owing to future events, then it ceases to meet the definition or the recognition criteria. We are saying this present obligation should be as a result of our past actions or past events. But the present obligation is in 2 forms. It could be legal or constructive. When we are talking of legal, this is something that has been established either by contract or by law. Okay? There should be some contract that is enforceable at law, that is forcing the company to become obliged to some certain liability or certain actions. All right? So, look here, ladies and gentlemen. A legal obligation usually arises from a contract. It might, for example, include warranties sold with products to make good and repairs required within a certain time frame. This is actually common in manufacturing companies. Okay, when they manufacture, let's say, refrigerators, when customers buy those refrigerators, they usually buy with warranties. Okay, that says that after a certain if the refrigerator fails to perform within a certain period, then the customers are allowed to return the refrigerators for repairs free of charge. All right, so those ones are legal obligations. They are enforceable at law. Okay, so this one is a legal obligation is enforceable at law. But the obligation could be constructive. Okay, could be constructive. All right. A constructive obligation arises through past behavior and actions where the entity has raised valid expectation that it will carry out a particular action. For example, a constructive obligation would arise if a business which doesn't offer warranties on its product has a history of usually carrying out free small repairs on its products, so that customers have come to expect this benefit when they make a purchase. All right? They're actually not forced to do it, but they have created some valid expectation, okay, in their customers that they will do it. So they are actually forced to do it. And International Accounting Standard number 37 recognize that business practice, and it allows businesses to consider those obligations. Okay, they are considered. Usually, companies will be forced in only to protect their image, okay, because it might end up, it will not augur well with their image, okay, if some customers start to complain over the radio or the print press, okay, printed media. I mean, that would tarnish their name, so they would not want to allow that. So for the purpose of preserving their image, their goodwill, then they will be forced to ensure that they meet these valid expectation. Okay, so that's the first condition that has to be met. An entity has a present obligation legal or constructive as a result of past events. Obviously, the past event would have been the sale of a refrigerator or whatever product that could have been sold. Then it is probable, that is more than 50% likely, that a transfer of economic benefits will be required to settle the obligation. Yes. The issue of probability is actually very important. When you're talking of probable, then it means that the chance should be 50% or more, okay, that a transfer of economic benefits will be required to settle the obligation. Okay, remember, the transfer of economic benefits doesn't mean that there is always going to be money that is going to be actually transferred. We are only referring to economic benefits. This could be money or other costs which could be incurred. For example, labor costs in making right the dead refrigerator. Okay, if we are going to deploy our workers from the factory to attend to a customer's broken refrigerator, then that is an outflow of economic benefit. It's a transfer of economic benefit. Okay, so it doesn't mean that when we are recognizing some monetary value, then automatically we are going to incur an outflow of cash. No, it could be an instance of incurring further costs, as in this case when we are repairing a refrigerator that has been broken, a customer's refrigerator, then we are going to actually commit our workforce in the repair of a refrigerator, which is a cost and a transfer of economic benefits. Okay, there's going to be a reliable estimate. Okay, I mean, there is need for a reliable estimate to be made of the obligation. Where we do not have a reliable estimate, then we cannot recognize a provision. So there is need for us to be reliably informed of the cost of this obligation. How much are we supposed to pay by the end of the day? All right. If it is an issue of a legal claim, we need to inquire from our lawyers on how much the legal damage is going to cost the company. Now, if the payment is probable, that is 50% likely, then the liability should be recognized in the financial statements. So we need to consider the probability for us to recognize the provision. But if the payment is only possible, that is between 5 and 50% likely, then the liability is not recognized in the financial statements but should be disclosed by way of note. Okay, it should be disclosed by way of note. So what does that mean? Obviously, this will mean that it ceases to be a provision but becomes a contingent liability. It automatically becomes a contingent liability. It ceases to be considered as a provision, but instead it will be considered a contingent liability. What about if the payment is considered remote, that is less than 5% likely? Then it is not recognized in financial statements, and nor is it disclosed by way of note. In this case, you just do nothing. Just ignore about it. Okay? Just ignore about it. Okay. When a business, the ledger accounting or the double entry bookkeeping that is required with regards to provisions. When a business first sets up a provision, the full amount of the provision should be debited to the statement of profit or loss and credited to the statement of financial position. Remember, when we are saying a liability, all right, here we are creating a liability because a provision is said to be a liability. All right, so this means that initially, according to this statement, initially the statement of profit or loss, okay, the statement of profit or loss is affected, as well as the statement of financial position. All right, in the statement of profit or loss, an expense has been created. Okay, initially when we create a provision, the full amount is taken to the statement of profit or loss, okay, as an expense, and also that full amount is also considered a liability in the statement of financial position. All right, but if you still remember, in our previous lecture we talked of the PL's acronym, okay, the PL's acronym, where we say that these guys, the first three letters of the PL's acronym are debits and the other three are credits. And we say that the first the first letter P is for purchases. When we buy goods for resale, okay, we consider those goods purchases. So what happens in the books of accounts? We debit the purchases. The purchases have been increased. Purchases is an expense. It's another form of expense, okay, for goods. An expense incurred by the business on goods for resale. So we call that one purchases. All right. So purchases are increased by debiting. You debit purchases. Expenses. Expenses are costs of the business. When you incur an expense, you increase the expense account by also debiting. This is why you are seeing here debit expenses, profit or loss. Then assets. Assets are properties of the company. They are increased again by debiting. We debit. Okay, so that's the first three letters of the word PLs. Then we go to the credit side. The credits are revenue or sales, liabilities, share capital, share premium. These guys are increased by crediting. They are increased by crediting. So in our provision case here, two things have been increased. Expenses have been increased by debiting. Also, the liability has been increased by crediting. This is why we credit provision. This is a liability. Are we together, ladies and gentlemen? I hope we are moving on the same page. Okay, in subsequent years, adjustments may be needed to the amount of the provision. The procedure to be followed then is as follows. Calculate the new provision required. Compare it with the existing balance on the provision account, the balance brought forward from the previous accounting period. Calculate increase or decrease required. If a higher provision is required, then you continue debiting the expense account with the increase. Remember, with the increase only. Am I talking to somebody? With the increase only, and not the whole figure, but with the increase only. I hope they have been understood. And then you credit the provision with that increase in the provision only. All right, then you go to the second situation. Sometimes when you do your computations, you would realize that a lower provision is now required. Okay. In the subsequent years, you may discover that a lower provision is now required. Let's say initially we had considered a provision of 10,000. All right, but we discovered that after further consultations, maybe from the lawyers, they're now saying the likely damages which can be claimed by this guy are going to be 6,000. So it means that there has been a decrease in the provision. A decrease is actually a gain. A decrease is a gain. So we go to our PO's acronym here. All right. We had initially recognized a liability, okay? But this time, the liability is now being lowered. So we need to lower the liability. How do we lower the liability? When we want to lower the liability side or the credit side, we have to debit that side. This is lowering. We are now lowering the credit side. So this is why we are saying, if you are seeing here, if a lower provision is needed now than before, then you have to debit provisions. Debit provisions. We are not debiting here. As you can see there, ladies and gentlemen, please, ladies and gentlemen, take your time to replay this video. Because if you do not replay this video, you're going to fail. That's the problem. That's the problem, my sisters, my brothers out there. If you do not play this video or similar videos like this, you are going to fail. So you need to actually replay and replay so that by the end of the day, you are a master of accountants. All right. So we have to debit the provision by, that is to lower the provision. Then you have to credit expenses. Okay. You have to credit expenses. Remember we say that expenses are increased by debiting. So when we are crediting now, when we are crediting, we are lowering expenses. And that's a gain to us. Okay, so do we lower the expenses with the whole figure of the provision? No, with the difference, the decrease. All right, much of the talking, let us do the right thing. Let us do, let us go practically. Okay, let us go practical. I'm sorry, I'm erasing these things because if I do not erase them, then you guys are not going to benefit. Okay, a business, right? A business has been told by its lawyers that it is likely to pay 10,000 damages for a product that failed. The business duly set up a provision at 31st December 2007. However, the following year, the lawyers found that damages were more likely to be 50,000. How is the provision treated in the accounts at 31st December 2017? 2007 and 31st December 2008. In the year to 31st December 2007, we have recognized, we need to recognize the full amount of the provision, okay, of 10,000, because this is the year when we have been told by the lawyers that we have to pay 10,000. So the full amount of 10,000 has to be taken to the profit or loss account and our statement of financial position. Okay, so what we can do, or what we need to do in the first year, we have to debit, all right, debit damages. All right, this is an expense, statement of profit or loss item. How much? 10,000. And credit, okay, and credit provision in the statement of financial position, SFP 10,000. What about if the examiners might say, give us the extract, prepare the extract statement of profit or loss and the extract statement of financial position. So extract statement of profit or loss. Okay, then under the expenses section, because this is what the examiners will be testing you to show them that you understand that the provision is actually an expense in the statement of profit or loss. So that you just have to say provision for damages, and you write your figure $10,000. Then you go to the extract from the SFP. Remember, there is a from there. Okay, we put these provisions as liabilities, but remember, according to International Accounting Standard number 1, presentation of financial statements, there are two forms of liabilities. There is a current liability and a non-current liability. So in this case, we put provisions under non-current liabilities. But why? Because we do not know whether the liability is going to be paid within 1 year or outside 1 year. All right. So why are we specifically saying the liability should be put under the non-current liability? The reason is that because we do not know when the liability is going to be settled out, so it is actually safer to consider the liability non-current, okay, because we do not know the timing. So actually the reason for our worry is actually the reason for our endorsement. All right, we do not know. All right, so this is why it is treated as a non-current liability in terms of International Accounting Standard number 37. All right, please do not worry, do not be worried anymore. Okay, so that's, we call it a provision for damages. $10,000. Okay, what about, so this was 31st December 2007. What about in the year ended 31st December 2008? How are we going to deal with this situation? We are now told that the provision is now 50,000. I mean, the damages are now 50,000. How are we going to treat that in our records? Shall we put the whole 50,000 or what? In this case, we just have to consider the difference, and the difference is how much? Okay, difference is equal to 50,000 minus 10,000, the initial provision, and we get 40,000. We then have to establish if this is an increase or decrease. If it is an increase, then we should follow the increase procedures. If it is a decrease, then we follow again the decrease procedures. In this case, it is actually an increase. So we are going to follow the rules as we have learned so far. So in this case, we're going to debit the expenses, okay, debit the damages as usual by the increase 40,000, and credit provisions 40,000. Remember, these damages are in SPL, statement of profit or loss, and these ones are SFP. Okay, so the extract from the SPL, statement of profit or loss, would look like this: expenses section, expenses, and then we say provision for damages. How much? 40,000. Okay, provision for damages is now 40,000. Then the extract from the SFP. Here now, I want you to breathe. Okay, it is still under the non-current liabilities. I want you to breathe. We are told here, it is more likely that we are going to pay 50,000. How much are we going to recognize as the provision? $40,000. Somebody is saying 40,000 in his mind. Ladies and gentlemen, we are going to recognize the 50,000. Okay, so we're going to say provisions. Provision for damages. We had our 10,000 initially plus the 40,000, and we're going to recognize 50,000. That is it, ladies and gentlemen. Let us move on. How do we measure provision? The amount recognized as a provision should be the best estimate of the expenditure required to settle the present obligation at the end of the reporting period. The estimates will be determined by the judgment of the entity's management, supplemented by the experience of similar transaction. If the provision relates to just one item, the best estimate of the expenditure will be the most likely outcome. When a provision is needed that involves a lot of items, for example, a warrant provision, where each item sold has a warrant attached to it, then the provision is calculated using the expected value approach. So we are saying that if the provision is actually related to one item, let's say a legal suit or a lawsuit, there is no need for us to pull things, okay, using expected values. All right, but we just have to wait for the outcome of the case. All right, but if it is a provision related to known things, a lot of them, which involves a lot of items, then we could use an expected value approach. The expected value approach takes each possible outcome, the amount of money that will need to be paid under each circumstances, and the weight. And weights it according to the probability of that outcome happening. All right. So let us go through example Benson Co. Benson Co. sells goods with a warranty under which customers are covered for the cost of repairs of any manufacturing defect that becomes apparent within the first 6 months of purchase. The company's past experience and future expectations indicate the following pattern of likely repairs. All right, so percentage of goods sold, defects, cost of repair. All right, so 75% of goods sold do not have defects. All right, So the cost of repairs is actually 0 because there are no defects. All right, and then 20% of goods sold have got minor defects. The cost of repairs are just 1 million. And then 5% of the goods sold have got major defects, and the cost of repairs is 4 million. What should the warrant provision in based on cost financial statements be? All right, so we have to provide the best. We have to make a provision on the basis of the expected cost of repairs under the warrant. So the expected cost of repairs. So expected cost is actually an issue of the expected value approach, the EV approach. Expected values, outcome multiplied by the probability. So simple, easily. So that's the expected value approach. So we're going to say EV of repairs, EV of cost of repairs, of the cost of repairs is equal to it's given there 75% or 0.75. That's the probability. You know, those percentages represent probabilities. Okay, 75%, okay, multiply by 0, all right, plus 20% multiplied by 1 million. 20% multiplied by 1 million plus 5% multiplied by 4 million. If we use our calculators, ladies and gentlemen, let me try to punch my calculator. We get 400,000. 400,000. This is the cost of the repair and should be included as a provision using the same principles. You debit statement of profit or loss, that is provision for damages, provision for warranties or warranty provision for warranty, okay, and credit provision, SFP. Remember, this one is SPL. Done. Now the requirements of International Accounting Standard number 37. This was also our objective, ladies and gentlemen. What are we required of doing? Okay, contingent liabilities. In respect of these, there are certain requirements we should meet, okay, or we should satisfy, right? But we have also noticed that contingent liabilities, they are not provisions. All right, we have noted this one in our earlier parts of the lecture. All right, so how do we treat this one? Because if they are liabilities, then they become provisions. All right, and the provisions are recognized in the financial statements. But if if these liabilities fall short of the provision of becoming or of being considered provisions, they become contingent liabilities. So they are disclosed as notes. They are disclosed as notes to the financial statements, okay, but not accrued unless the likelihood of payment is remote. less than 5%, in which case there is no disclosure required. All right, so if a contingent liability is actually remote, then we do not have to disclose it. We only have to disclose a contingent liability if it is possible. If the liability is possible that it could be paid, then then we have to disclose it in the form of a note to the financial statements. But if a past event has given rise to the possible obligation, for example, a lawsuit, then it is treated as a provision, and if the payment is probable, more than 50% likely, then it should be recognized in the financial statement. So if it is 50% or more likely, then we have to recognize a provision. This becomes a provision. Okay, please watch out for these terminologies. All right, so there should be a chart on which we should base our decisions. All right, but all right, let me just try to draw out this chart. I'm not a good artist, but I'll try to ensure that the chart is actually readable. All right, so let's start with our issue here. All right, let's start here. All right, is there a present obligation? We need to ask ourselves, is there a present obligation as a result of an obligating event which occurred in the past? Okay, is there a present obligation, a PO? All right, if there is a present obligation, let's say if the answer is yes, then is the outflow probable? Is the outflow probable? We also have to ask ourselves, if yes, then is there a reliable estimate? Is there a reliable estimate? Remember, we have indicated that the amount should be based on some reliable estimates, and we did demonstrate an example, in the form of an example, on how to come up with a reliable estimate when we did the warranties example. All right, so is there a reliable estimate? Here, let's say we said yes. Here, if we say yes, so obviously we should recognize a provision. What about in one of these boxes we had said no? Let's say here, is there a present obligation? And the answer was no. Is there a present obligation as a result of an obligating event? We said no. Okay, we then have to ask ourselves, what about a possible obligation? If our answer is yes, what then shall we do? If our answer is no, what shall we do? Okay, if our answer is actually no, then we just have to go and get a cup of coffee we have to do nothing. No action required. We have to do nothing. All right? What about if there is a possible obligation? We then have to ask ourselves, possible obligation, are you going to lead to a possible outflow? If the answer is yes, okay, we have to disclose contingent liability. Where? In the notes to financial statements. That's where you do your disclosures. You do not do disclosures on WhatsApp. You don't do them on a campus notice board. They are done to the notes to the financial statements. Okay. All right. So what about if the answer was no? Obviously, we're going to do nothing. You do nothing. Okay. Now, what about here? If there was a present obligation as a result of an obligating event, all right, and the probable outflow was said to be no. Okay, we then have to ask again this question. All right, if it is a no, we go to this. If it is a yes, we then come down again to disclose. All right, if the answer here, if the reliable estimate, okay, if the reliable estimate was said to be no, which is usually very rare. It is usually very rare. We then have to disclose. If there is no possible estimation of the amount, then we have to disclose a contingent liability. Now, let's talk of contingent assets. For contingent assets, if virtually certain, that is more than 95% likely, then it is not a contingent asset and should be recognized. Okay? If it is virtually certain, if the inflow, we are now talking of inflows. Remember, these are inflows. If the inflow is virtually certain, that is more than 95% likely, then it is not a contingent asset. It should be recognized as a financial asset. It becomes a financial asset. Okay? It becomes a financial asset for the business. But if it is only probable, if it is probable, more than 50% likely, but less than 95%, then it should be disclosed by way of note to the financial statement as a contingent liability. So contingent liabilities and contingent, as a contingent asset. Okay? Contingent liabilities and contingent assets are disclosed in the notes to FS. The difference is that in the case of contingent liabilities, the probability should be 50% and or more. Okay, but when it comes to contingent assets, all right, the probability, okay, the probability should be the probability should be 50% or more, okay, for them to be disclosed. All right, but when it comes to contingent liabilities, all right, for contingent liabilities, it should be up to 50%. If you still remember here, that just come here. All right. If the payment is possible, that is between 50 to 50, between 5 to 50%, all right, then such a liability should be considered as a contingent liability. However, if the likelihood is above 50%, you recognize a provision, all right? But in the case of assets now, in the case of assets, for them to be recognized as assets, the likelihood should be 95% or more, okay? 95% or more, so that you recognize a financial asset, all right? But if the probability, if it is only probable, all right, that is more than 50% likely, you have to recognize, you have to present it in the notes to financial statement. You're not going to recognize anything in the financial statement, but you are just going to disclose. All right. So your recognition is in a form of a disclosure. All right. So that simply means that although contingent assets are disclosed, the probability should be 50% plus for them to be disclosed. However, if it was in a liability situation, if the probability was 50% or more, then it constitutes recognition in the financial statements. All right, it constitutes a provision. But in the case of assets, even if the probability is 50% or more, you're only going to disclose them. All right, you just need to disclose even if the probability is 50% or more. All right, up to 95%. Then you then have to recognize an asset after 95%. Okay, which means anything below 95%, even above 50%, you just have to disclose. All right, so that's how these guys differ. All right, they are both disclosed. These contingencies, the contingent liability and the contingent asset, they are both disclosed in the notes to the financial statements. However, for prudence sake, all right, the liabilities need to be thoroughly disclosed and accounted for. Okay, this is actually a logic by the International Accounting Standard Board to ensure that there is business continuity and the principles of prudence are exercised. It is actually better to overstate expenses, all right, than to overstate profit. We need to overstate expenses, all right, and understate profits. That's actually the logic behind. So in the case of contingent liabilities, the probability should be 50% or more. In the case of liabilities, the probability should be 50% or more for them to be considered for provisions. But in the case of contingent liabilities, the probability should be from 5% up to 50% for them to be considered as contingent liabilities. All right, and if the likelihood is less than 5%, you can ignore that. Is called remote. Okay, that's the level of being called remote. Now, when it comes to contingent assets, the probability for them to be disclosed in our notes to the financial statements, they should be a 50% or more likelihood, up to the 95% threshold, okay, for them to be disclosed. Otherwise, do not disclose them. This is if the likelihood is only either possible or remote, that is less than 50%, then no recognition and no disclosure by way of note. This is actually a very strong point. All right, so it is a bit confusing, but by the end of the day, you master it. All right, so in case of contingent liabilities, probability is between 5%, and 50%. Okay. When the likelihood of a financial asset is 95% likely, 95%, more than 95% likely, then we can then recognize a financial asset. We can recognize an asset and not a contingent asset. A contingent asset is only more than 50% likely, okay, but less than 95. All right, I think that is that. Okay, so if the likelihood is at 95%, is this an asset or a contingent asset? Obviously, this is a contingent asset, because anything below, anything up to 95%, from 50% up to 95%, that one is a contingent asset. A contingent, a financial asset is more than 95% likely. Okay, a financial asset is more than 95% likely. Please let us get these facts correct, because if we misunderstood them, then we are going to be in trouble. So a financial asset is more than 95% likely. A contingent asset is an asset whose likelihood is more than 50%. All right, but obviously up to 95%. All right, so any such assets would need disclosure in the notes to the financial statements. Okay, I think we just need some decision table so that we can sort everything out clearly. So let us do a decision table here. All right, I'm a good artist. I've already given that qualification moments ago. So, ladies and gentlemen, bear with me as I draw this funny table. All right, let me try to change the pen for it to look nice. The likelihood, okay, likelihood outflow of resources, okay, inflow of resources. All right, I hope this table is going to clear the dust. All right, remote, possible, probable, and virtually certain. Okay, all right, let me try again to get another pen. All right, so if the likelihood of a liability, all right, if the likelihood of a liability is remote, then do nothing. Don't disclose in the notes, don't present it in the financial statements. If again the likelihood of an inflow is remote, then do nothing. Ladies and gentlemen, remote is a percentage below 5%. Okay, we're talking of less than 5%. But from 5%, I mean, about 5%, okay? I'm sorry. Okay. This is the possible area is okay, which could be shown this way mathematically: 5 is less than x, okay, less than 50, okay, something like that, between 5 and 50. All right, or up to 49%. Okay, so this is the possible threshold. Okay, all right, in this case, if it is possible, you then have to yes, you just have to recognize a contingent liability. But remember, a contingent liability is not recognized in the financial statements. The word recognize, like I said, should mean to include in the financial statements. In this case, a contingent liability should be disclosed, rather. Let us use the word disclosed. So disclose a contingent liability. It is less than 50%, yes. It is possible. All right? It is possible. So you need to create a contingent liability that you need to disclose. All right? You need to disclose a contingent liability. But what about in the case of an inflow? An inflow is not yet at the threshold of recognition. All right, in this case at 50%, I mean below 50%, it should be ignored. So do nothing. You see the prudence issues, because managers were known. Remember the Enron scandal, the Enron scandal. You need to Google Enron scandal. We need to prevent such scandals to happen. So managers should not disclose assets which are only possible, okay, but not probable. No, such a thing is not allowed. All right, but in case of liabilities, a contingent liability should be disclosed if it is possible. Are we together, ladies and gentlemen? Then we have got being probable. All right, here we are talking of 95%. That's being probable. Less than 95%, but above 50. So we are talking of 50. All right, it's less than. In this case, let me just try to find out here. All right, so the issue of this bracket should have been here. Up to 50. Okay, the possible region should reach 50. All right, should reach 50. All right, so but here now, this one should be above. So 50 is greater than, I mean, is less than x, less than 95. Okay, so we are talking of values which are above 50 but less than 95%. All right, so that's the probable region. All right, less than 95% but above 50. All right, so in that case we have to recognize a provision. Here you disclose contingent, here recognize a provision in financial statements. You have to recognize a provision, and here you disclose. It's now probable. All right, it's now above 50% likely. Okay, above 50% likely. All right, but less than 95%. So disclose a contingent asset. What about here? Virtually certain. Obviously, if it is virtually certain above 95%. Okay. This is above 95%. What happens is we recognize a provision. Right? That's a provision. Still a provision, and here we recognize an asset. So an asset is actually recognized when there is 95% chance that we are going to receive that. It should be virtually certain. This is where we recognize the financial asset. All right, I'm sure that we have covered everything we need to know about provisions. All right, so ladies and gentlemen, we just have to take a sip for now as we continue, because like I said, we need to touch on the remaining areas, the IS 16 as well as the IFRS 9 issues to do with receivables, bad debts, and allowances for receivables. All those we need to cover them in the coming lecture. But until then, may you continue to feel very, very excited, and don't forget to subscribe, to share, to comment, to like. All those things, those are just easy things to do, ladies and gentlemen. They're just easy things to do. Just have to click the share button and you share the video anywhere, everywhere around the globe. That's what we need to do, ladies and gentlemen, for now. That's the right thing for us to do. But if you also feel like, hey man, it is actually a noble idea to support us directly, okay, wherever you are, ladies and gentlemen, the good Lord is going to continue blessing you, all right? But I do not want to, to make you feel obliged, all right, because it should be done out of clear conscience and without any manipulation. Do not be tricked into it, okay? Do not be tricked into supporting somebody when you are not yet convinced that it is the right thing to do, okay? So I just appeal to you, if you feel that this video has been so helpful to you and it is furthering your objectives, please just buy me a cup of coffee, all right, on the link provided. You can just use this link, or you can just scan this QR code and you are directed to where the donation can take place, all right? And if the scanning is actually an issue, you just have to download. You can simply download a QR code, okay? Download a QR code reader application on Google Play. You can just do that, and then that will make your job easier, because the moment you download that app, then it is going to scan you and take you direct to the point where you can make whatever donation you feel like. But like I said, please feel very, very excited, because more videos are going to come where we'll be taking one another through the process of accountants, right? May the good Lord bless you. I'm signing out. Thank you.